Before we start the show, Andy, I'd just like to say a quick thank you to our podcast sponsor, Wealthsimple, one of the leading online investment platforms globally. Now, Wealthsimple manages over £3 billion for more than 200,000 customers. Wealthsimple prides itself on providing access to smart, simple investing without the high fees and account minimums usually associated with traditional investment management. In fact, you can open a stocks and shares ISA, a SIP or a junior ISA with as little as £1, which is far lower than any of its peers, and every client has access to unlimited human advice from a qualified investment advisor. Now, Wealthsimple also provides ethical investing options and produces an online magazine in an attempt to demystify the world of money. Money to the Masses podcast listeners can get their first £10,000 with Wealthsimple managed free for a year if they sign up at wealthsimple.com/money to the masses. You can also check our full review of Wealthsimple online at moneytothemasses.com.
Hello and welcome to episode 266 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leeks. Damien, welcome back. How you doing?
I'm good, Andy. I'm good. I know I said it last week, but this does remind me so much of when we used to do the podcast, where I haven't actually physically seen you for some time, and I could almost sit there and ask you what you've been up to and everything like that, but I know the answer is nothing because we're still in lockdown. So it's like the old days, but not. But yeah, we've obviously all been working hard at Money to the Masses, haven't we? And would love to say I've had anything other than working on Money to the Masses to tell people about. In fact, this lockdown has only emphasised the fact that I don't do anything else other than work and do stuff for Money to the Masses. We've been so busy. And I need to get out a bit more when we're allowed to, I think that's the learnings of this last 3-4 weeks.
I've learned as well that obviously people who are lucky enough and who have a garden that they can go out into have been posting pictures on social media. The weather's getting better. I don't even have that luxury at the moment because I've moved into a new build property. The turf isn't down properly. There's no space. Everything's piled up. So I'm not even getting out into the garden at the moment. So I need to sort that out over the bank holiday weekend and sort the garden out and make sure I can get some fresh air, because I do feel like I reckon I've only left my house 3 or 4 times in 3 or 4 weeks, which probably isn't healthy, is it?
We're going to just be this slightly dodgy shade of grey with really big beards and haircuts. At least you though, Andy, you can cut your own hair and still look as good as you normally do in your own beard.
What I've got left of it, yeah.
Yeah, and that unfortunately for the rest of us is going to prove it difficult. So I might just end up looking like you. But other than that, everything's been good. We've been pushing out so much content at the moment. We are doing lots of video, lots of audio. In fact, I've been asked by one of the newspapers to do some Q&As for them as their money expert next week. So that's quite interesting. I'll tell you more about that next week. So do keep an eye on our social channels. We're putting out a lot of Q&As, a lot of video content, like I said, and stuff that isn't going to appear in the podcast or necessarily in our newsletters or on the site. So do check those things out. Thank you to those of you who have left reviews as well. So I'll read out a couple of those, Andy. Slightly self-indulgent, but I think it would be nice to encourage other people out there to leave reviews because they do really help us and inspire us. So Ginger Dad left a review 2 days ago, 5 stars. Enjoy listening to this podcast and love the delivery style and useful information. Keep up the good work, guys. Excellent. And we had Coops 1877, 5 stars, top work, guys. High caliber content and importantly, views. So that's great to see. So do leave those reviews in the relevant places, iTunes or whatever podcast apps that you use. And who knows, at some point when we're out of this mess, some of you may even be able to have a Money to the Masses mug.
Yeah, that'll be good, actually. It'll be nice to get back to sending out the mugs and getting people up on our mug wall of fame. That'll be excellent. So what have we got coming up on this week's show then, Damien?
Right, I mentioned about the lockdown, and it's kind of a nice lead into one of the pieces that we're going to do today. Well, 2 of them, in fact. We always try and be evergreen with the content that we do on these shows, but we are in unusual times, so I'm adapting part of the show to relate to the current environment. But one of the pieces is about teaching your children. I'm not just talking about small children, I'm talking up to like GCSE age children about money and personal finance. Now, we've all turned into school teachers in the last 3 weeks, having to understand the hell that teachers have been going through for years, that our darling child might not be the darling angel that everybody thinks they are, and actually teachers' jobs are far harder than people usually give them credit for. And so I want to talk about some tips and things that people can be doing to teach their children about money. Because if they teach them about other things, then why not teach them about money? Because we don't get enough of it in the curriculum anyway. So I'm going to touch upon that. I want to do an investment piece, but it's been 2 weeks since I did an investment piece, really. And there's been an interesting time in the last month or so with markets have crashed. And sometimes I think you don't want to let an opportunity to learn go to waste. And I'm going to be talking about targeted absolute return funds and some interesting thoughts on those. And finally, Andy, you're going to be doing a piece on...
I'll be covering an interesting development that a few of the banks and big grocery retailers have been doing to help those that are self-isolating. So look out for that at the end of the show.
Yeah, so we're doing contemporary and evergreen mashed together. So even if you listen to this in the future when we're all out of this lockdown, then the content should still be relevant. So what I'm going to do, I'm going to go straight into the investment piece. Now, targeted absolute return funds. I don't know if you know what they are, but these are the funds that used to be called absolute return funds. You can see what they did there. They just bunged the word targeted in. And these are a sector within the unit trust world that are funds that they're basically heavily marketed to make money in any market condition. Now, over the years, they've obviously had to come clean because we've had some epic sell-offs, that they don't actually make money in all market conditions, and some of them do pretty badly in certain market conditions. So what happens in the money world? We get these phases where there'll be a new, almost gimmick, a marketing idea that people use to increase, I say people, investment houses use to increase their assets under management. The more money they manage, the more money they earn from their percentage fees. And absolute return funds were something that came around many years ago, and the number of absolute returns funds hasn't actually increased that much in the last few years. It's pretty constant. It's around about sort of 68 or something like that. Now, going forward, we're going to get new fads. We're going to get all these smart beta funds or different things like that might end up in these sectors. So you always got something new that comes along. And the targeted absolute return funds entered this recent sell-off. And if you looked at your portfolio, if you hold any of these funds, and be honest, most people will probably hold at least one. And if you've got a financial advisor, you'll almost certainly have some, because they are a bit of a favourite of advisors. And you will have seen that they have tumbled. So you'd expect equity funds to tumble. And we actually saw bond funds have a tumble as well, because all assets were correlated. But absolute return funds almost en masse fell during this sell-off. So you think at the point where you really need them to diversify your portfolio, they didn't do that. And in fact, there was only about between 2 and 4 funds out of that 68 targeted absolute return fund sector that actually made a positive return since the sell-off began. And I mean, that's pretty poor given the impression that they are meant to do something more than just fall alongside everything else. They're meant to diversify your portfolio. So the learning is obviously that they don't provide absolute returns in all market conditions, and that is partly why they changed their name. Now, if you're listening to this, go back to podcast 78. So I'm going back a fair way, and I've listened back to that podcast today, and I did a whole piece on absolute return funds. That was their name back at that time, and it was really interesting to listen to it because I explained how they worked, because they don't tend to be just long equities or bonds or anything like that. They sometimes have a real range of strategies that they employ to try and beat the market or the index that they're benchmarked against. So go back to that podcast, have a listen to that section, and you'll understand more about how they work and why these funds supposedly differ from the other funds that are out there that are a bit more sort of vanilla, transparent equity funds and bond funds. Now, one of the things that's come out of the recent sell-off is that it helps people understand what these funds are actually doing. Because I always remember going back in the day when I used to work in the financial services sector, and we used to make portfolios for clients, and there was a fund at that time called the Standard Life Global Absolute Return Strategies Fund. It was shortened to GARS, and it was a beast. I mean, this thing absorbed billions of pounds worth of money from investors, and it did perform quite well for a period of time. And it was a great strategy. It was, in terms of not the fund itself, but a marketing strategy, it was really popular within the industry and with clients. And trying to understand at that time what the fund did was impossible. And I remember having the guy, what you used to have is you'd have somebody who is like a rep, who would represent the fund house, and they'd come round to different financial advisory services, try and promote their funds, try and get the IFAs, the financial advisors, to promote their funds to their clients. And this may be a big eye-opener to people out there. This is how the world works. It still works like this. Well, they're basically salesmen in a way, and they go around and they answer any questions that you have. But ultimately, in the days long gone now, fortunately, because the FCA clamped down on it, they were the people who used to take people away on trips to, London 2012 came to town. They would have big jollies at the Olympics and people would go to that. And it was always to try and influence the advisors who had lots of clients to recommend their funds. I digress anyway. So I remember having that guy come in and say to him, like, how exactly does this fund make its money? Because it was so complicated, and when it used terms that you didn't really understand. I talk in the podcast 78 about pairing strategies. It used that, but what it had was other strategies. You couldn't really work out when the fund would do well and when it would do badly. And my personal view is that you should always try and understand in what environment a fund that you hold, whether it's targeted absolute return fund, whether it's a bond fund, equity fund, or whatever, in what environment will it do well, and in what environment will it do badly, and what factors will influence that. And with that particular fund, I could never understand it. It was almost you just see what happened. And the rep couldn't actually tell me. He basically didn't know. He knew the marketing stuff, and he gave me the spiel, and I didn't understand it. Anyway, cut a very long story short, the years have gone by, and that fund has since not done very well at all, has had a lot of negative press, as its early success wasn't sustained, and it had long periods of underperformance. And so it still exists, and it still has a decent amount of money in it, nowhere near what it had in its heyday. But it's a story that the moral is, if you don't understand what you're investing in, and this was something that was probably one of the biggest funds in existence that was widely recommended by financial advisors and the financial services system. It wasn't some real crazy way out there esoteric thing. It was a unit trust. Then if you don't really understand it, then perhaps you shouldn't be investing in it. And so what the opportunity you've had since February for any fund is to see what it really is doing, like underneath the bonnet. Because you can look at the fund fact sheet. So that's the first port of call when you get a fund. You think, what's it doing? When will it perform well? When will it perform badly? So you may look at the fund fact sheet, and it may say, for example, it invests in some of its holdings. They'll normally only tell you the top 10 holdings, and so there'll be like 5% in this or 5% in that. So they might say it's got a certain like 5% in US treasuries. Well, therefore you will know that there's going to be a currency element, unless it tells you it's hedged, that if the pound falls, that will give a boost to the portfolio because of the currency exchange. If the opposite happens, the pound rallies, that will be negative. Obviously, if treasuries rally, that will be positive for that part of the fund, because they've got lots of holdings and you can't always see all of them. And of course, with absolute return funds, those lists of the top 10 holdings often don't make any sense at all anyway. So what I suggest people do, whatever the fund, chart the fund using something like TrustNet. So if you go to TrustNet, Google it, it's a site that has a lot of financial data on there and has some articles as well. But you can go on there, you can go into the unit trust tool they have, look for a fund, and you can look for a lot of information on that fund. More importantly, what you can do is it will chart the performance of that fund, but you can then compare that fund to its benchmark, maybe its sector average. But more importantly, you can compare it to anything you want. So you can compare it to an equity sector. So you might compare it to the UK all company sector, or you might compare it to the sterling corporate bond sector. And so go on TrustNet, have a play around, pick the sector average, look at the tool. It's quite easy to use, and start comparing a fund that you might have in your portfolio where you're not quite sure what it does. So particularly a targeted absolute return fund. And you should start to see a similarity, hopefully, between its performance and that maybe of another sector. So I'll give you a real life example. In my portfolio that I had recently, I had a absolute return fund, and what they can be good for is diversifying a portfolio away from things like bonds. So normally what happens, you have equities and you might have bonds as a diversifier. You may have other assets as well, maybe property or whatever, but targeted absolute return funds can be a good diversifier because they may not necessarily don't behave as the same way as some of those other assets. But when I looked at my portfolio recently, I could see that the targeted absolute return fund that I'd held that had been a very good performer and had done very well had dipped as well in the recent sell-off. Not crazily, but it had dipped. And I was looking at it and I was looking at why it had. And you look at the different things it invests in. And by charting its performance against other sectors, I could quickly see that the reason why it had fallen, it was influenced by the sell-off in the bonds, in the corporate bonds that happened recently, not necessarily its equity exposure. So the biggest impact on that fund's performance in recent months has actually been bonds and corporate bonds, which is why it had done so well up to a point. It does have equity exposure, this fund, but it wasn't actually that caused the fund to fall. In fact, during recent periods of equities falling, the fund had done relatively well. So it was most sensitive to a tumble in bonds, so yields going up. That seemed to be the most likely way that fund would lose money. So by looking at that, I can then make a judgment call. Is this really going to diversify my portfolio now if we see a sustained sell-off in bonds? So the message is, look at the fund, look at its benchmark, because that will give you a clue as to what the fund manager thinks it is not tracking, but it's trying to beat. So that might give you an indication of what the performance might be influenced by. But it doesn't always, because a lot of targeted absolute return funds just pick a cash-based benchmark. Right? It'll be some cash benchmark plus 1 or 2%, something like that. But if you benchmark it yourself against different sectors, you could get an idea of what's having the biggest influence on that fund. So going forward in future, if you go to look at a fund and you're trying to work out, well, what will drive the performance higher on this fund, or what are the risks in this fund, look at periods where you've had a very quick rally or very quick fall and see if you can match that with other assets or sectors to see what has been driving that. And often you can find out the answer very quickly, even if the fund fact sheet or marketing material that they produce isn't very clear. And the other thing is that it goes back to that example I said, if you really can't work it out, then it may be a question of perhaps you don't want to invest in it because you don't understand it. And a lot of targeted absolute return funds aren't really producing much more than cash anyway, even over the longer term, because they are trying to hedge things out and they end up almost taking out everything, and the fund almost flatlines. But as I say, in the recent sell-off, the average fund fell 9%. The average targeted absolute return fund fell 9%, which is about half to a third of what the equity markets fell. So that isn't really reducing. It's obviously reduced risk, but not down to the level that you would hope, given that it's a low risk sector, as it were. So the message is, try and evaluate what a fund is doing. If you can't work it out by looking at the materials, then start to match it against something else that it almost mirrors, and then you can have a pretty good insight into what is actually going on beneath the bonnet of the fund.
I mean, having listened to what you've said there about targeted absolute return funds and the way they work and the fact that they're complex, but you've given solutions as to how people can actually dig in under the bonnet, if you like. from just listening to that and not being an experienced investor, I can't see many positives from them. What are the positives?
I mean, I think they actually are quite positive in upward moving markets. This is just a personal opinion, because what they can do is some of them take a bit more risk than a low risk fund. So like if you were thinking a low risk asset, maybe bonds. Now, if we had a really strong equity rally, they can capture some of the upside. They tend to be quite good at capturing some of the upside. So they're not necessarily protecting on the downside. The problem is they're all very different. So it's like having a race that has got Formula 1 cars in it and all types of other Formula Ford or Formula 3000 or whatever, all these things going on.
Some are going to be good on the corners, some are going to be good on the straights, some are going to be weighted in different ways. I can see that's a good analogy.
And they're just trying to do it their own way to get over the finish line. And some of them aren't even bothered about necessarily beating anybody else. And so I think for me, I've just from history and just experience looking at them, I think what they can be is they can be a good diversifier, as some of them have proved. So there were some that made money in that period that fell. So that is a very good way of looking at funds and seeing when funds. This is what I use in a stress test tool on 80/20 Investor. It's a stress test tool, and I pick different scenarios in history that have happened, and they coincide normally with big sell-offs that have been triggered by certain things. And I look at every fund gets a score based on its performance relative to other funds within its peer group. And in the instance that we've just seen, there were 4 funds that actually made a positive return within this sell-off. So therefore, you'd automatically home in on those and think, well, they are a good starting point potentially for funds that could diversify a portfolio if we have a similar scenario to what we just had, a similar backdrop. So, as you say, Andy, as a group, they're very difficult to pick apart, but I think there are some that might limit the downside, but they tend to limit the upside too. But I've just found when they've worked within the portfolio that I've had, it tended to be as a way when a market is doing very well and is rising, they tend to be a way of almost squeezing a bit more return out of the stuff in your low risk end of your portfolio, because they're probably doing a little bit more risk than just being in fixed income bonds. They're doing other things, maybe equities on there as well. So it kind of ramps it up. But of course, that's why when we hit the skids and we hit the wall, we get a scenario where they can actually underperform. So they're an interesting group. It's not saying that they're absolutely terrible, but I think the marketing has now got to the point where people are a bit confused what they do. And it's just shining a light that when you buy anything, you've got to try and understand it. Don't just go by the label. The old, don't judge a book by its cover.
Okay, great stuff. So moving on to the next piece, and you mentioned earlier in the podcast, Damien, financial education. We're all homeschooling at the moment. We're all trying to do our bit, but financial education is one of those things that I think they struggle even at schools, isn't it?
Yeah, I mean, it's barely on the curriculum. So it's funny, just like everybody else, we're all having to be teachers. We've found out how difficult being teachers actually is. And I mean, my school's hardly sent home any work for them to do, and it's just playing the kids will be kids, let them be kids. We don't teach them much in school anyway, which was a bit of a shocker when they sent that email down to us. But basically that's what it said almost, that it takes them ages to pretty much get them to settle down and explain what they've all got to do. Don't worry that they're not doing a lot of work at home, because they effectively, paraphrasing, don't do a lot in school. But anyway, so while we're teaching children things, it made me think about teaching children about money. And in the past, I've been asked this by podcast listeners. And one of the things I've always said is to be quite practical about it and let them see you using money in shops. So not just your card, not just tapping your card, but using coins and getting change from a shop. But of course, in lockdown, we can't do that. So it means you have to be a little bit more creative. And it got me thinking. And also, I saw some bits from Hargreaves Lansdown who were talking about how you could teach children about money, some nice resources online. So it got me thinking about, are there some good resources that can help teach children about money? Because like everybody, it feels like maybe the kids need a break, but at the same time, in this environment, I don't know about you, Andy, but we're all having more uncomfortable discussions probably about money, because everybody's feeling the impact of what's going on with the coronavirus, and money is tighter than it's ever been almost, and that's certainly true for most people. And it's not easy to get hold of things, and the cost of things is going up because of demand, and so we're having to have conversations with our children that we wouldn't have previously, almost sheltering them in some way. So a lot of people realise they're having the same conversations about money they probably wouldn't have done. So I thought it's quite nice to talk about some resources online, and there are one or two very good ones. So I'm going to go through a few of them quickly. Most of these we'll put in the show notes for you to be able to look at them, but just to give you the sort of high level, BBC Bitesize does a lot of good stuff online for children. I mean, they used to do, I remember them from when I was younger, doing bite-sized revision for people, for children in their exams, but they do stuff for Key Stage 1 and Key Stage 2, which is obviously in primary school. And there are some good topics they cover in there relating to money. Some of it is mainly mathematics. They don't actually have sections on the curriculum that say about personal finance as such. So it's more about understanding some of the maths that is useful in using money. But where it also gets interesting, if you look at Key Stage 3, which is the point where you're moving on to secondary school, they have some good lessons about working out interest or understanding percentages and rounding and estimation. As I say, we'll put links to these in the show notes. But if you Google Key Stage 3, BBC Bitesize and Working Out Interest and the other titles I've mentioned, you will come across them. But it gets particularly interesting at the sort of 14 to 16 age group, because there is a BBC Bitesize financial decisions guide, and I've looked at it and it's very good. I've listened to it, and that's definitely worth looking at. But probably the best thing I've seen online is the Your Money Matters financial textbook that you can download from young-enterprise.org.uk. Now it's effectively a textbook, but don't be put off. I've downloaded it, looked at it, gone through it, and it's engaging, colourful. It actually looks like something that you'd actually want to pick up and teach children from. There is a teacher's guide that goes alongside it, and this was the textbook that Martin Lewis was behind. He did this in conjunction with Young Enterprise, and he put some money behind it. I think he sent a hardback copy to every school, but you can download a free copy online as a PDF. And if you go through it, it teaches things like saving and spending, borrowing, good and bad debt, risk and reward, investment, student finance, tax and national insurance. I mean, it even talks about issues such as payday loans. It generally works by giving some theory, some examples, gives them some questions to look at, some answers, some case studies of people about, for example, one of them in there is about spending, and they go through and they have case studies of particular people and their spending patterns and habits, how they're influenced by digital marketing. So it gets you thinking about money in a wider context, about how you're influenced to spend and how banks may work. One of the good examples I saw in there, they were doing exercises trying to get children to understand the money that banks make from people's savings. So if they pay a particular interest rate on your savings versus what they make on lending money, then they had to work out how much profit the bank was making. And I think it's always great to understand how the banking system, the finance system works, because that's how you can then understand it, and therefore you can make better financial decisions. So there are discussion topics. I mean, I think it's very good. So I would go and download it. There will be a link in the show notes, and you can use that and go through different topics, print bits out. And I think that is really useful, particularly for children between the ages of 14 and 16.
No, that's brilliant. I'll definitely recommend my eldest look to that. Is there anything, though, for the younger ones? You and I have both got a younger child, and obviously they can't do the same sort of level of stuff as the older ones.
No, I mean, there aren't so many. I've not come across many online resources, but for the younger children, some of the best suggestions I've seen out there are playing some of the games that involve pretend money. So we're not talking Monopoly. We're talking things like, I mean, there's a game we play called, I think it's called Go to the Shops, which is a very simple game that's almost like a kind of Ludo idea. You're going around a board, but you're buying things from shops using pretend money, so coins. So it's enabling children to be able to work out the cost of something, how many coins it takes to buy a loaf of bread, but also the change they get back. And the aim is just to complete your shopping, not necessarily to have the most money. So it's not trying to teach people to be hoarders or megalomaniacs or anything like that. It's actually just teaching them the idea of being able to use fake money and get change. And I really like it. But the other one I've seen, I think it's something you do, Andy, is you get your children to earn money by doing chores. And so they start to earn money, and therefore they learn the value of it. And that in itself is probably one of the biggest life lessons you can give children. Yeah,
absolutely. I had a recent one this week where my oldest daughter saw a film she wanted as a digital download and said, Daddy, can we get that? I want to get that. And I said, yeah, we can get that. But you either earn it by doing your chores, or, I mean, I think your daughter, Damien's the same as mine. They're hoarders. They tend to cling on to their money. I know that she's got a piggy bank full of money upstairs. So I said, oh, you can give me the money now, and we can buy it now. So anyway, turns out that she chose the first option, which is to earn the money. But yeah, it's helped her understand that things do cost money. You need to work to earn it, which is good.
Fair play to her, Andy. I mean, my daughter is a definite hoarder. She shares the same characteristic. I'm sure we sometimes end up at the shops going to buy. She's going to spend some of her pocket money and deliberately doesn't have quite enough money with her, so I would end up hopefully making up the difference. And she's very shrewd. Let me just say that, very shrewd with money. So, I think it's a great idea doing chores for money. One of the things I was talking to my wife about, that we needed to try and do a bit more of that, partly because to keep our own sanity, because it feels like I'm forever cleaning up the house, and my wife is feeling exactly the same, chasing around after 2 children when you're in lockdown. It just feels like a grenade goes off in every bedroom after, probably on like a timer every 15 minutes. The room is decimated with stuff everywhere and toys everywhere, and everybody will be feeling this. You go to sit down at night and you're just feeling like I'm spending an hour tidying. So maybe I need to get them to be doing that for pocket money. Anyway, that was the financial lessons. I think it's quite nice to have some online resources, and some very good ones, as I say, out there in this period where we can't actually go out physically and teach our children about money by letting them see us use it. Of course, it goes without saying, if you talk about money, that always helps as well. Just get them to understand. I mean, I heard some stories about people thinking, I remember asking my own children, how much do you think a house costs? The answers you get from asking a child, how much do you think a car or house costs? And you get some amazing answers. You really do.
Yeah.
Anyway, on to the next and final piece, Andy. We were talking about some innovations that some of the banks and supermarkets are doing in this current environment. I mean, it's very useful in the current environment, but hopefully they'll keep some of them ongoing.
That's it. So some of the digital banks, the online app-only banks, they're obviously very good at innovation, but also the big grocery firms out there, Asda, Waitrose, Sainsbury's, they've all come up with ways that they can help people who are stuck at home self-isolating. So if you haven't heard of this already, and if you're in that position, then you should definitely check this out. I'll go through the grocery firms first. So the big retailers, M&S, Asda, Waitrose and Sainsbury. There's talk that maybe Tesco will join too. They've created a way that you can digitally load an online card for groceries, and then you can send that card directly to whoever the person is that you've nominated to be carrying out your daily sort of shopping, your essential shopping, if you like. So it's a good way to stop people having to hand over cash physically. Obviously, cash isn't great at the moment with the coronavirus, and without having to actually even physically hand over even a card, or have to go online and do online banking. So like I say, M&S, for example, you would go online, you would order an online card, a digital card, and you would load it, and it would be sent direct to the person of your choice. Asda and Waitrose and Sainsbury's, from what I can work out, it's a similar process, but it's more of a digital gift card. So it can be sent by email and then scanned in at the checkout. So same sort of thing, but it's not a physical card. And the person who you send that to can then take that along to the shop, carry out the shopping as normal, and then drop the shopping off, obviously while being able to socially distance. And there's no interaction between you and that person in terms of transferring any money or hopefully the virus, which is really good. Starling is an interesting one. Now, they're one of the new digital online app-only banks. They've actually created a whole new card that you can order through the app, and it will arrive in 3 or 4 days to your house. So unfortunately, you do get a physical card sent to you, and you will have to pass that card to someone. But there are ways of doing that sensibly.
Like launch it across the road. Like you used to do when you were at school, you used to put them between your fingers and you used to flick them and they used to fly,
Yeah, flick it across like that. And once you've got that card, you can actually set a specific PIN number, different to your normal PIN number on your own debit card. And it will have a limit of up to £200, and you designate an online space. Starling do something called Spaces, which, think of it like just a separate savings account where you don't have access to your full money. You just put a little bit of money aside in that pot.
So it kind of carves up your current account, really. That's sort of a little bit that's portioned over there that they can use on that card.
That's exactly right. And you don't have to mess around remembering account numbers, and it's all the same account number. It just comes out of a separate portion of, like you say, it's carved up into a separate portion. That card can be given to someone to do the shopping on your behalf, and they can keep hold of that. You can access that card yourself from your app. You can top it up from the app. You can cancel the card from your app, replace the card with the app. So it's really user friendly and easy to use. What's really good about it is it can be used in any physical shop. So whereas the Asda, the Waitrose, the M&S cards are great, they can only be used in those specific shops. With the Starling Connect card, which is what they call it, you can use it in any shop that accepts card payments. It can't be used for online payments. It can't be used for gambling or anything like that. It is purely for physical shopping. So it's really versatile.
I really like it. I mean, it's not Starling loving or anything. I think it's important to point out companies that innovate and try and come up with solutions to issues that are out there that the consumers have, and it's not the first time they've done it. Others will generally follow. And I think if you talk about these things, people become aware of them, they can use them, and it also encourages our existing banking system and our existing banks and building societies to try and come up with solutions to problems that consumers face, not just be at the moment. A lot of them are getting a lot of flack because they feel like they're just being a hurdle, a wall to then be able to access money or anything, or some of the lending that they might need to keep their business going. So I think Starling should be applauded for the innovation that they've done, and presumably they may well keep it going, I'm guessing. But
well, that's it. What I thought was quite interesting about the Connect card with Starling is it would naturally morph, once this is all over, into a separate spending card that you could probably hand over to your children for their school lunches, or if they go off to university, where you can siphon off some money into that account to help them out as a backup if they needed it. I think it's really good.
Yeah, I think it's a nice idea. Let's hope other people follow. So that is it for this week, isn't it, Andy? We are done. As ever, do leave reviews, as I mentioned earlier. Do join our Facebook group, facebook.com/groups/money to the masses. I'm looking to do another Facebook live chat answering your questions directly. You can post those questions in the Facebook post that I've put within the group, and I will answer them anonymously in the chat. And you can ask me questions live as well when I'm doing it. So the chat will most likely take place, assuming that there are sufficient questions that people want me to answer, on Friday the 17th of April, so the Friday after Easter.
Great stuff. So get your questions on the Money to the Masses community group for that. If you want to get in touch with Damien for anything else, it's damien@moneytothemasses.com. Twitter, it's @moneytothemasses with a number 2. Of course, we've always got loads of stuff on Instagram and YouTube, so go and check that out as well. Damien, we're done. Until next time.
Until next time.